Well, the clock on the wall says 7 o'clock, so good evening and welcome to the fourth quarter capital market review. This covered the last 3 months of the calendar year 2014. Happy New Year to each and every one. Today we're going to talk about a few things that have to do with the economy. I want to make it a little bit more relevant, so we'll talk a little bit as well about oil. Every quarter I come up with a theme, and I would have to say 2014 was the year of singularity. And what I mean by that, and we'll see this a bit later on this evening, it was a great market if you were completely in the S&P 500. If you were in anything other than the S&P 500, the returns were much less robust. And since we adhere to a multi-asset, globally diversified portfolio, our balanced accounts were not quite where the S&P was. This is my 32nd year, actually starting my 33rd year in the business. And I can look back on my career and say there may have been 3 years where you saw this huge outperformance on the S&P compared to other asset classes. Now, I don't have a good reason for that. It may very well be that a lot of investors piled into the index, but that is an odd issue about this past year. The reason we host these is we think the economy does matter. We want to dissect several major components. We want to look at economic growth, the job market, corporate profits. What does the economy have to do with inflation? Because as is the case, most of you are retired, and protecting purchasing power is above and beyond the most important aspect, quality, and target. And then we'll also talk a little bit about interest rates. Our hope is that we answer to some degree where we are and, more importantly, where we're heading. Kind of fine-tune things and take out of the equation some of the short-term noise that creates quite a bit of anxiety. Our purpose is to stay balanced, stay diversified, and as a result, stay invested. I also, each quarter, come up with several themes to talk about, and we want to make this as relevant as possible, certainly for this quarter and the upcoming year. So tonight, we're going to talk a little bit about oil. How does the current price issues of oil translate into our view on the economy? We'll also focus on the economy, and in particular, Fed action and inflation. How does our view on the economy impact the Fed and inflation forecasts? We will also talk about investment assets, and we'll talk in particular about the short-term and the long-term view on these investment assets, both stocks as well as bonds. And our discussion tonight would certainly be remiss if we didn't talk a bit about global investing. While not particularly popular right now, the importance of global investing and its potential impact on forward-looking returns. And then I'd like to finish with a brief discussion about why staying balanced is the best approach, and also some additional random thoughts as we look forward to the unfolding of this upcoming year. So with that in mind, let's kind of see how things fared this past year. This is a great example of the S&P 500. We certainly see the big run-up during the dot-com bubble and then the burst. We saw the big run-up, basically just simply a recovery of what was lost the beginning of the last decade, and then the severe drop that we saw from 2007 to 2009, and the increase since, this leading up to December 31st. While the S&P did quite well, I would have to admit that we're probably in the later innings of the U.S. economic expansion. Unemployment came down pretty sharply over that period of time, and we're really not sure how much more the unemployment rate can drop from here. Even though it's a bit later in the innings, we don't think it's quite the time yet to leave the game. We don't want to abandon risk assets at this point. Going forward, however, it's probably going to require us to be a bit more careful in the selection. Up till now, it's been as if an expanding economy, a rising tide, has raised all ships. Going forward, it's going to be a bit more selective in the use of tactical assets within the portfolio, and to some degree alternative assets within the portfolio to take off either stock or bond risk certainly will make some sense. Also, when you look at the makeup of the S&P 500, the returns were all over the place. Last year, energy was down nearly 8%, telecom was only up 3%, materials were up 6 or 7%. Things that were very interest rate sensitive, like utilities, fared very well, whereas things that were less interest rate sensitive didn't perform quite as well. So the returns were really good with respect to large cap US, but even within that space, the returns were presented quite a large range. And then bonds. This is interesting. This last half of the year, this past year, we actually had a surprising drop in interest rates. The 10-year bond rate was at 2.17, and it has fallen actually further since the beginning of this year, setting new all-time low rates. That is certainly not sustainable, and the greatest risk is at some point interest rates will start to rise. In fact, lately the expectation is, does the Federal Reserve raise rates this coming June, or do they put it off a bit further in the year? There are very few people right now debating as to whether or not the Fed will raise rates sometime this year. And that's a game changer. At that point, things become a bit more problematic for bonds. So turning back to the original agenda, let's look at oil prices. And with respect to oil, there are probably 3 questions that we need to answer. One is, why did oil prices collapse? Where will oil prices go from here? And what do current oil prices mean both for our economy and the world economy as a whole? So let's start with that very first question. This is a great chart. This chart shows production of oil globally and consumption of oil globally. So since 2013, production has increased 2.9%, or roughly 2.6 million barrels. And consumption has increased as well by about 2%. So right now we are producing a little under 1% more oil than we're consuming. It's interesting because that buildup of inventory producing more than we're consuming just simply doesn't justify a 50% decrease in oil prices. And what's also interesting is this entire 2.6 million unit of production gained almost all came from an increase in U.S. production, which increased 20%. We produced 2.6 million additional barrels over that period of time. We think some of this is a result of the Saudis both attempting to punish Russia and also to kind of weaken the production demands of U.S. shale output. So let's talk a little bit about where we go from here. I don't think these low prices are quite as sustainable as some people think. Looking out 2 years, I would certainly expect oil prices to come back up. Whether they go to $100 a barrel remains to be seen, but I certainly would think that we might see them actually increase to maybe $80 a barrel. Look at this chart and you'll see the big drop in oil that was during the Great Recession and the almost immediate increase. And one of the reasons for that has to do with elasticity. In the short term, oil isn't extremely elastic, but it's very elastic in the long term. So as an example, when we see pump prices drop as they have today, it may cause us to drive a bit more. We may take an extended trip. We may run up north 1 or 2 more weekends. That type of activity doesn't really change the needle too much in terms of demand or consumption. But when it comes time to lease that new car or buy that new vehicle, if oil prices continue to remain low, it may cause us to go out and buy a larger vehicle or an SUV. At that point, there's quite a bit greater demand being built into the equation. The same is true on the production side. If we're running an oil field and oil prices drop, and I can continue to maintain the fixed and variable expense by continuing to drill, I will continue to do so. So in the short term, the drop in price doesn't impact production, but a drop in price will impact my decision to go out and lease additional real estate upon which I may want to raise additional wells. Eventually, demand goes up and supply goes down, and you get this dislocation in equilibrium, and oil prices will in fact go back up. So how does this impact the economy? It clearly will help consumers. In fact, the percentage of income spent on oil, gasoline, motor oil really helps the lowest of the wage earners. A greater percentage of their income is spent that way. It improves consumer confidence. It increases discretionary income. Effectively, this drop in oil is equivalent to a $100 million tax cut. It's equivalent to the 2% payroll cut we had a few years ago. That eventually will increase demand for goods and services and can also help our GDP grow a little bit faster. On the global scale, the same is true. If you look at certain countries here, developed and emerging markets, you'll see here's the U.S., and we're still a net importer of oil at about 1.6% of our GDP. But Italy, France, Germany all import a greater percentage of oil than we do, and this cut in price will help stimulate economic activity there. The same is true for countries like India as well as China in the emerging market space. This will certainly help, and that increase in demand is really just what the Eurozone needs. Let's spend a few moments and talk about the economy with somewhat of a focus on the global economy. We talked a little bit about GDP growth and how it came back a bit last year. In fact, last year, GDP grew at about 2.7%. Now that's impressive because prior to that, GDP was averaging about 1%. It had been down in this 1 to 2% range, pretty anemic. And when you look at the drop here and the increase here over that 7-year period, it's been about a 1% growth. So this was an outlier. We had much better growth this past year. The bulk of GDP comes from the consumer side. This coming year, we expect GDP to grow at a rate of something greater than 2.7, could be above 3%. We will see some degree of improvement in investment ex-housing, some degree of additional expenditures coming from government spending, but the bulk of the economy is driven by consumer consumption. And that's really where these gas prices will really help. So what does this mean for inflation? Well, it's really interesting because at this point, headline inflation is 1.3%. But if you back out food and energy, which gets us to core, you're backing out a negative number, which actually increases the core. So core inflation, which drives payroll adjustments, drives Social Security improvement and whatnot, is actually growing at about 1.7%, whereas headline last year was at 1.3. With the drop in oil, we expect headline to be a lot closer to zero. This orange line will probably move down to the zero range. Core could actually move up to about about 1.9 or 2%, and this will eventually bump inflation. If over the course of the next 2 years we also see an increase in energy cost, that will also have an impact. Consumer spending, additional spending, will have an impact as well. At some point, the gray line, which is core, will overtake the orange line, which is headline, and that's expected to happen sometime mid-2016. At about the same time, by the way, that energy prices really start to increase. What does this mean in terms of the labor market? And this is one area where the Fed might be a little bit behind the 8 ball, and that has to do with the labor front. We've seen pretty steady labor growth. Almost 11 million jobs created. That offsets the nearly 9 million jobs lost. We continue to see labor force participation rate drop, meaning the pool of people who can work is getting smaller. Now, part of that is demographic. A lot of graduates are staying in school. A lot of graduates are underemployed. A lot of graduates, my kids are of that age, so we're seeing this with respect to their friends, are going on to get another graduate degree, decide to go into law school, and as a result, they're just not participating in the labor market. The other thing, also demographic, and this is a shocking statistic, of young men working age, 12.5% of them have felony convictions. It might be a very light felony conviction, but it's a felony conviction. So to some degree, some are actually being precluded from the job market because of security risk or what have you. The other thing is if you look at the ratio of unemployed to job openings, that's come way down. So the labor force is very tight. And as a result, this could lend itself to higher wages and wage inflation. I really like this chart. This chart is of unemployment and wages. The gray line that you see here is the unemployment rate, and you'll see it dropping from October 2009 at 10% to where we were in November at 5.8. I actually think we're tracking right now at about 5.7. The orange line is almost a mirror image, and it's been so for the last 30 years. That is actually wage growth, or the growth of wages. And what you'll notice is it tends to be a lagging indicator. When unemployment rates drop, it takes a while for wage rates to increase. And right now you're seeing wage rates just increase a little bit compared to the huge drop. Now part of that is it's always been a lagging indicator. It's always slow to pick up, but it always does pick up. And we may actually start to see, because of the very tight labor force, kind of competition, a bidding war on hiring, and that could drive some inflation tendencies higher yet. Now remember, I said just a moment ago that we're probably going to see the headline inflation number at 0 before it starts to rise. These are things that we're worried about a bit longer term. Let's talk about the Federal Reserve. All of what we said before kind of brings us to, okay, where's the Fed today? And let's look at this lower right-hand chart. This is actually based on the Fed minutes. And if you look at, and this is what the Fed is expecting will happen, they're kind of basing their policy on these economic assumptions. With respect to the change in real GDP, we have no problem with that. We expect GDP this year to be close to 3, maybe a bit over 3, and about the same in 2016. At that point, there might be a little bit of a slowdown. And part of the reason is at some point, the higher dollar will hurt imports and make some of our products a little bit less competitive. Where we think the Federal Reserve is a bit behind the 8 ball is in terms of their unemployment rate. In fact, I think unemployment's at 5.7, so really they're a little bit behind this number now. They expect the unemployment rate to be about 5.3 at the end of the year. We think it could drop to about 5, and we think it could be in the high 4s by 2016. Look at the Fed funds rate. They expect the Fed funds rate by the end of this year to be about 1.13. That's a full 1 percentage point increase. The Fed has 8 meetings a year. They generally increase by 25 basis points a meeting. They're not planning on starting until sometime after June. It's going to be a little bit hard to get to that number. And more importantly, what if they overshoot this and unemployment is 5 instead of 5.3? Then they're probably not where they need to be. That rate should probably be a bit higher. So the worry is, what if they have to play catch up? And what if at some point they have to increase rates half a point or more at a time? If that happens, that could have some disturbing impact and effect on markets. So these are things that we kind of look at and worry a bit about. So what does this all mean from an investment perspective, especially in terms of bonds? Well, the takeaway would be generally we sort of want to underweight fixed income. And with the fixed income that we need to have in a portfolio, we need to be a bit more selective with respect to what bonds we own. The short end of the yield curve, the 2-year bonds, that rate's likely to go up significantly because that's the rate the Federal Reserve is going to be pushing on. While the 20-year long-term bond or longer might not move all that much. Our rates are still quite a bit lower than Europe, and there's quite a bit of European demand for our bonds. 2015 might look a whole lot more like 2013, where interest rates actually started to back up and bonds generally lost a little bit of money, as opposed to 2014, where we were actually surprised by a drop in interest rates. Within the bond fund sector, high yield bonds still look relatively attractive. The default rates are low, 2 to 3%. Bonds in general are not cheap, but high yield bonds are not overly expensive either. Bonds actually sold, high yield bonds actually sold off a little bit at the end of last year. I think one of the reasons for it is 17% of the high yield U.S. universe is energy. There's very little energy exposure in European high yield and less than the U.S. market in emerging market high yield. So both of those areas would also be an alternative to the high yield market, sheltering us from other potential problems in the oil patch as a result of prolonged, cheap, low-cost oil. Another area of promise would be the international high yield and emerging market high yield marketplace. Default rates are still fairly low. Brazil has, at least based on repo rates, almost zero probability of default within a 5-year period, and yet Brazil is currently yielding almost 10%. So many of the emerging markets could be fairly attractive, low default rates, a low risk of default over 5 years, pretty fat yield, and the fact that if interest rates continue to come down, there could be a little bit of upside appreciation. The basic message here is to overweight equities as you underweight fixed income. Earnings on the S&P 500 north of $30 per unit are expected to continue to increase in the mid-single-digit range. That's pretty attractive. There's very little leverage in terms of corporate earnings, so it's all just selling more stuff, not leveraging out to show profit increases. And that is the cleanest type of earnings available. So this train is still motoring down the track. It is not derailing at this point in time, in spite of a bit higher U.S. dollar and some blowback with respect to some multinationals. When you look at the market, you could certainly say, look, the PE is a little rich. It's a bit higher than historic average. But if you look at the real earnings yield, it's still very attractive. At 3.7%, it's quite a bit higher than the long-term range. And when that happens, generally, it bodes favorable for the U.S. stock market. The spreads between S&P earnings yield and basically the 30-year bond is still very attractive. When they pinch or the yields become above stocks, it becomes problematic. When stock earnings yield is above bonds, it still indicates an attractive environment. Let's talk for a minute about where within the stock market one should concentrate. If we're talking about large cap, what we really would want to look at are areas that are carrying a little bit higher beta than the market, a little bit higher than 1. And we also want something that has positive correlation to treasuries. We want to avoid things like telecom and utilities because interest rates are expected to back up at some point this year, and that would be problematic of those. While they did well last year, might not do as well this year. The same could be said of real estate. Coming off of a great year last year, not so much this year if interest rates do start to back up. But things like financials, technology, even consumer discretionary should look pretty good this year. International stocks look even less expensive. When you look at the forward price to earnings, Europe is trading at 13 times earnings, emerging market 10 times earnings, compared to the S&P of 15 times earnings. That is quite a bit cheaper in the long term. It's tough to maintain a global perspective right now. The international markets really underperformed the U.S. this past year. But the reason is essentially the U.S. marketplace, the economy, is starting to slow down a bit. Growth will slow. And as a result, there will be a need to find growth elsewhere. This chart might be able to help. For the longest time, our economy grew at about 3%. We were getting about half of that from population growth, from employment growth, and we were getting half of that from productivity or output per worker. Unemployment dropped significantly the last 10 years. 2007, everything hit the skids. That was 8 years ago. And output per worker dropped off as well. Over the last 5 years during recovery, population of workers increased by about 1.1%. Output improved as well, but not to the same degree. So we've lost over a half a point of GDP growth. Other countries have built in to their demographic just simply better growth. Now, why did the international markets perform so poorly? Part of it is the strong dollar. If you look at Europe, Asia, Far East, the return was a negative 4.5 to us U.S. investors. In local currency, they were up about 6.5. Europe was up 7.5, but resulted in nearly a 6% loss. Emerging markets, the same. The dollar probably will strengthen a bit more in the near term. Europe is kind of borrowing Bernanke's playbook. They're buying bonds. They're going to keep rates artificially low. We'll start raising rates here at some point in time. But in near term, the dollar will start to kind of firm up. Part of it is goods and services become less attractive at some point in time. Our rate changes will start to keep pace with European rate changes. And at that point, the translation between U.S. to international dollar will become a little bit less problematic. Europe really looks attractive. If you look at most of the countries, the exception is Greece, we're seeing kind of a replay of 2012. However, those in the know, and I'm not suggesting I'm one of them, but people we read who handicap these things are suggesting there's actually less probability today that Greece will leave the euro compared to the same situation in 2012. Don't exactly understand why, but that's kind of what they're saying. Elsewhere, Portugal, Italy, Spain, Ireland, Germany, their rates continue to drop. Also, they're dealing with less of a blowback with respect to austerity. If you look at the period of 2010 to 13, these bars indicated the amount of GDP that was effectively lost because of self-imposed austerity programs. In Greece, 14%, Eurozone, almost 3.5% across the board. Today, 0.5%. So you're actually getting better GDP growth with less headwind because of these austerity programs. Global valuations also are another reason. If we look at many of the European countries, you'll see their valuations are significantly better than where the U.S. is. This is the U.S. The diamond represents current, the bar average. So currently our valuations are quite a bit above the average, and this gray bar from top to bottom is the range. So valuations are about as rich as they've ever been, and you can see a number of countries, Japan, Canada, Australia, UK, Europe, Asia, Far East, the index, are a lot closer to historic value. And if you look at demographics, you can also see why growth looks better elsewhere. Look at the U.S. Percent of population under age 20, 26%. The percentage of our GDP which we reinvest back into our economy, 20%. Compared to other developed countries, we look pretty good. When you compare that, however, to emerging markets, look at India, 38% under the age of 20, 35% of their GDP is reinvested. Look at Mexico, 36%, or Brazil, 33%. There's an ever-growing rate of workers, which bake into the equation for GDP growth. Emerging markets look very similar. Many of their countries are trading at or below average valuations, so they're cheaper still. Just a couple words on global assets and globally asset allocating. This is a great chart, kind of looks like a chemistry class. If you bounced around and looked at a particular color, there's commodities going from worst to best, back down to nearly the worst. Here's the Russell 2000, near the bottom, near the top, near the bottom, near the middle, near the very top. If you tried to pick assets based on previous performance, very, very difficult to do. To avoid that, by building an asset allocation fund, which essentially has multiple assets, the ride's generally a lot smoother. The performance isn't that far off a traditional S&P 500, but with a lot less volatility. As an example, over the last 10 years, this asset allocation fund, which is about 60% equity, would have given you a cumulative return of about 92%, compared to about 109 with the S&P, but with a lot less drawdown, a lot less aggravation. Most balanced asset allocation funds last year were in the 4 to 5% range, depending on the amount of international and emerging market exposure. We carried a little bit more international and emerging market exposure because the 5-year forward-looking return numbers favor international and emerging market. Year to date, that's helped as the returns are down much less than the S&P, which is down about 2.7% or so as of today. Not a huge sell-off in the aggregate, but this is starting out a lot like we started out last year. A couple random thoughts. First, where are we with respect to the cycle? I actually lifted this from a meeting I was at Goldman Sachs headquarters late in the fall, and they're pegging that we're in the third phase, the actual growth phase. And what happens is the market, which is this gold color, the returns are less robust. And part of it is, while we have really pretty decent growth in earnings, you have a compression of PE. The earnings get better, so the P over E becomes a bit less, and as a result, the lower multiple on earnings gives us less robust earnings. That's also one of the reasons that we need to look outside of the U.S. And then the last phase is this optimism or blow-off phase where earnings come in quite a bit, but everybody's on board, everybody's buying in, and as a result, the market really does well. So, as I said, we're probably in the 6th or 7th inning, later innings, but we're certainly not in overtime or in the 9th inning at this point. This was Goldman Sachs projections of where the S&P would be. We're at about 2,000 right now, down from about 2,050. They were very close to the target. They expect S&P earnings to grow from 2,050 to about 2,100. If you look at that, that's about a 2.5% earnings growth, and then from 21 to 22. So we're in that phase of slower earnings growth. Alternative investments can certainly help. We're looking at a number of them as a way of reducing risk in the portfolio, especially interest rate risk. Back in the day, alternatives meant real estate, energy, commodities. Today, they certainly represent those things as well as macro, global macro, or long-short equity, or event-driven. That would be like merger arbitrage. All these things have characteristics of reducing some degree of risk. Let me skip this and go to this chart. As I mentioned, we think growth will come from the international and emerging markets over the next 5 years, more so than the U.S. market. With that, there's some additional risk and volatility because now we're dealing with currency risk. One way of offsetting that is to use alternatives. And you can see from this chart where we're actually looking at real return from 1990 through June of 2014, annualized standard deviation. As I move into the right, we're increasing risk. As I'm moving up, we're improving return. And if you look at the stock market or the bond market, adding alternatives to the portfolio increases return, but also reduces some degree of volatility or risk. I show this slide simply nearly every quarter. This is annual return and the comparison of inter-year declines. All this is really saying is don't be surprised if we get these hiccups or stumbles along the way. S&P was up 11% last year. That was just point to point, not counting dividend. The worst drawdown we had was 7%. The average drawdown over the last 35 years has been 14.2, and you'll see where a drawdown of 14% or less, here's 13, really doesn't indicate that the account will be down for the year. During this year, 1984, the market was actually up 1%, but incurred a 13% drop. In 1987, the market was down 34% as a drawdown, but was up 2 on the year. We incurred a 10% pullback in 2012 and finished up 13. So don't fear the pullbacks. Generally, you'll see where it has very, very little indication of where we finish the year at. The other thing I want to mention is we do look at market seasonality. We are in the better period of time, November through April, year-end, beginning of the year. You tend to see a lot of money being deposited, pension, profit-sharing dollars are contributed. People fund IRA and Roth, and that generally helps. As we move into the summer, we tend to see a little bit of a pause in the market. If there is going to be a pullback, there's a higher probability it'll happen during that period. So in May, we certainly like to freshen up and tighten up some of the stop limit orders that we have in place. We like to also rebalance a little bit, and then we look at adding or rebalancing toward the end of the year as well. What I'd like to do is invite you to write in any questions if you have any. If you think of some after this presentation, please let Danielle know and I'll respond to you as well. And as always, we're certainly looking to work with other folks as well. If you know anybody who might like to have a second opinion, have us review where they are and see where they are in relationship to their goals and objectives, we certainly would like the ability to do that. With that in mind, I'd like to wrap up, but before I do, I'd like to invite you to at least stay on the video and look at and read through all of our disclosure slides that'll follow the conclusion of my presentation. So with that in mind, thank you so much for being on the call. If there's anything I can do for you, please don't hesitate to call, and we'll see you again right here next quarter. With that in mind, thank you and have a wonderful evening. Good night.